All right, the fundamentals of investing is today's notes. Make sure that you have your note taking guide open in DocHub. This is, I will warn you, just a little bit of a long one, 4 pages on these notes, and it's a lot of information. We're covering everything that there is to know about investing and all the different kinds of investments. But feel free to take breaks whenever you need to, pace yourself, whatever you need to do. So, starting out with a definition, investments are assets that are purchased with the goal of providing additional income from that asset itself, but it all carries a risk of loss. So, part of your financial plan should include savings, but you should also include some investments. So, all investments do have some amount of risk. And you'll notice that probably the next few blanks on your note-taking guide are not necessarily in the order as listed on your note-taking guide. So just look for places where I have underlined um, words, and those are probably going to go somewhere on your blanks. And I will try to point out all the ones that do go on there. So all investments have some risk. That is one of them. And to define investment risk, that is right here. It's the possibility that an investment will fail to pay the expected return. Um, Also, I think the definition of return is on this slide, and that would be the profit or income that's generated by saving and investing. Investments have the potential for higher returns. So we've now answered the top 5 blanks in a weird order. Sorry about that. So the trade-off is if you want higher returns, meaning you want to make more money on your investments, there's also a higher risk of loss, the chance that you could lose everything. So the two go together. Okay, I think we're ready for the next slide. Investments are an important part to building wealth and, net worth, and that is on your slide as well, your next blank. So, why are investments less liquid than savings tools? So, remember, liquidity has to do with how quickly and easily you can convert it to cash. Savings tools like savings accounts and money market accounts, those are easily converted to cash compared with investments. Investments are not intended to be easily converted to cash. You're intending to put that money away and continue building it for later, way down the road when you need it. Okay, so investments are typically for long term goals, and that's another blank on your sheet. And some examples of long term goals. I've given you 3 here. It's only asking for 2 on your worksheet. So, buying a house. At your age, maybe you're thinking that you will buy a house sometime in your life, but maybe it's going to be 5 or 10 years down the road, maybe longer. So that would be a long-term goal. Higher education, for you guys, not so far away, but maybe for your kids, eventually you'll want to have a savings plan for your kids' college fund or something like that. And then retirement, which is very real eventually, especially as you get older. And so the rate of return is defined here, a total return on investment expressed as a percentage of the amount of money saved. So a very simple calculation, the total return, meaning the total amount of profit that you made on that investment, divided by the amount of money that you initially invested equals your rate of return. And so here's a quick example. Mandy saved 2,200 in a money market a deposit account. After 1 year, she has a return of $110, meaning that she initially invested the 2,200 and $110 is what she made on that investment, the profit that she got back. So if you take that divided by that, you would get 0.05, which is the same as 5%. So that's where the rate of return is. If you ever hear that terminology, that's what it means. And so you would want to strive, this is the bottom of your sheet, strive to have the rate of return on investment be higher than the rate of inflation. And so what's inflation? You've learned this probably in social studies classes. It's the rise in the general level of prices. And so there is an inflation risk that the money that you're putting into that account or investment today won't be worth as much in the future because of inflation. Inflation. Oh my gosh. So you are striving to have a rate of return on your investment at least as high as inflation and much higher if you can manage it. So, different types of investment tools listed here, and we will go over each one of them. Starting with a bond. And so the definition of bond is right here. It is a form of lending to a company or the government. So you buy a bond and you are therefore loaning your money to that company or the government and for a specific amount of time. And then you are kind of guaranteed a fixed interest rate that you should be able to expect back in the end. Sorry. The description is right here. It is an organization that pays interest to the lender or the purchaser until the maturity date is reached. So if you've ever heard of a savings bond, I don't know, those were big when I was a kid. It's like, hey, you can pay $10 now, and in 10 years, it'll be worth $25. So you have a specific amount of time that you're supposed to be able to cash that in, and that's known as the maturity date. Also listed down there. I don't even think that's on your notes. So the risk level on a bond is really low. It's the least risky of all investments typically, but it does depend on the type of bond, the specific amount of risk. And the returns are going to come to you, meaning what you're getting back are coming to you in the form of an interest rate, a fixed interest rate in this case, meaning the interest rate doesn't change over time. It's always the same. Next, stocks. So, definition of stock is a share of ownership in a company. And therefore, a stockholder or a shareholder is the person who owns that stock. So, you buy Apple stock, you are now a stockholder for Apple. You own a piece of that company. And the risk level on stocks are medium, but it certainly depends on the type of stock that you get, what company you invest in, and a lot of other things. But we'll just go with medium. So there's two ways that you can get money in profits from a stock, and one of them is dividends. So dividends are going to be a share of the profits that is distributed in the form of cash to stockholders. So if over the course of the year a company makes $100,000 in profit, they're going to split that up among all of their shareholders and give you an actual check. That's what dividends are. So an actual check that you're getting based on the profits of that company. Not all stocks are going to pay dividends. Well, of course, there's the thing where they didn't make any money, so then they wouldn't pay you dividends. But the other way is capital gains. So essentially, capital gains just means that you're buying a stock for one price, you're selling it for a higher price, and therefore you've made money on that purchase. But it could also go the other way, of course. It could lose money, and then you will sell it for a lower price than was paid, therefore you're losing money. So capital gains definition is specifically down there at the bottom of the screen. Real estate is another investment. That just means that you are owning residential or commercial property, commercial meaning like businesses, or land. And the risk level here is medium. There are different ways that you can get returns in real estate. You could have capital gains, meaning you buy a property, maybe you flip a house and then you sell it for a higher price. And so that's called capital gains. The other way would be in the form of rent. So maybe you buy a home and then you rent it out. And so you're getting regular rent payments from that person. Speculative investments, I'm going to just briefly review. There's a lot of them out there. So, definition, these are investments that have the potential for significant fluctuations in return over a short period of time. So, yes, you could make a ton of money really fast, but it's also the highest risk type of investments of any of them. And some examples include futures, options, and collectibles. And as far as return, it really depends on the type of investment. So there's a lot of different, that's all you got to say about that. There's a lot of different ways to get returns. Mutual funds, we're on the next page already. Wow, we're zipping through this. So, definition of mutual fund there, when a company combines the funds of many different investors and then invest that money in a diversified portfolio of stocks and bonds. I'm sorry that's so long. Essentially, it's like taking a little sliver of a share of a whole bunch of stocks and then putting them in one big fund and then allowing people to buy a share of that fund. So your risk goes way down because now you are owning a lot of different things, little pieces of a lot of different things. So if some go up and some go down, overall, you're going to still earn a kind of a steady, hopefully steady rate of return. So, included in mutual funds would be things like bonds, stocks, real estate, and speculative investments. We're going to buy little bits of all these things and package them in a little, you know, little mutual fund. Types of returns you can get from mutual fund, typically interest, but also you could be getting dividends. You could be getting rents if you're buying a mutual fund that has more real estate in it, or capital gains. Again, that just means that we're buying something and then we're selling it. And the risk level here is medium. This is a really popular one, though, and I'm going to answer the rest of those bubbles in a second, but I'm just going to. Oh, here it is. Never mind. Advantages are that it saves investors time. So I don't have to go out and research a whole bunch of different companies to decide who to invest in the stock market. And therefore, it also reduces my risk by buying just a little piece of all those companies. And like I said, they can fluctuate. Some of them can improve, and some of them can go down. But overall, I'm kind of staying average. And the disadvantage is that fees could be high. Here's a quick visualization. So Ariana has $150 to invest. She could buy one stock, one company's stock. She's going to buy some stock from company C. However, if company C has a bad year and their market price drops significantly, she may lose all $150 that she put into that stock. But on the other hand, if she buys $100 worth of a mutual fund, she's essentially buying a little piece of all of these companies. And some can go up and some can go down. And overall, she's reduced her risk and she may still earn money. Not necessarily, but she probably will. So, an index fund, and that's the next blank, I think, is a mutual fund, but it's a specific type of mutual fund that is like guaranteed the average current earning funds in the market. So it's like we take everything that is earning kind of the average, like that index. Where would we say this is kind of the baseline that everybody else is comparing their mutual funds and their stocks to? It's like, well, here's the line, the steady line, and we're going to just buy all those because at least it's being steady. And that's kind of the whole point of an index fund. It's just to be average, but that's just lower risk than going with a lot of the other kinds of mutual funds. So, quick talk about lending types of investments versus owning types of investments. You can either lend money and be paid for it. So, for example, when you lend money in the form of a bond, and then they are going to pay that back with interest, or Yes, interest is the return there. Or you can own things. So when you buy a stock, you own a part of that company. You own real estate, or most speculative investments involve owning. And you can get the returns in that way in different ways, such as dividends, rents, or capital gains. And just knowing the general risk level helps you to manage your risk. If you're looking over here, these are our lending kinds, our bonds, mutual funds, index funds. Those are earning interest. And then we have the owning types, dividends, rents, capital gains, and all of the different types listed under that. But what you need to write down on the form is this part: the lending in investments that are a form of owning, these over here, carry a decreased inflation risk because they have a higher interest rate. They have increased potential for high returns, meaning making more money, and an increased investment risk, meaning also the potential to lose all that money. Next page. So, investment philosophy just is like your personal tolerance level for how much risk you are willing to take on. Generally, we divide this into three categories. You could be a conservative, moderate, or aggressive. A lot of people want to just say that they're moderate, but it depends on where you're at in life. Time may influence your investment philosophy. If you are really close to retirement, you don't have a lot of time for a market to go up or to go back down and then recover. You're probably going to want to be really conservative at that point in life. But now, while you guys are young, maybe you want to be more aggressive and you want to try to earn a lot of money really quickly, knowing that you have time to bounce back if it doesn't work out for you. Portfolio diversification. This is really, really important. This just means that you're reducing the risk of loss by spreading your money into a wide array of investments. You don't want to put all your eggs in one basket. You don't want to buy only one type of stock, because if things go bad, you may lose everything. So the goal in diversification is to create a collection of investments. They're going to provide an acceptable return on average overall, with an acceptable exposure to risk. So you got to find your comfort level there. And the whole purpose of this is to reduce your investment risk. And side note, investing in a mutual fund is an automatic form of portfolio diversification. Oops, yes, there we go. So the stock exchange and the next few blanks, I'm going to have several slides, so I just ask you to bear with me, but I'm going to try to explain the entire stock market. So there's that. The stock exchange is where you purchase your investments. So this is a central location where all stocks, bonds, other investments, anything that's traded. And there are several stock exchanges worldwide, but only certain people are qualified to be able to actually buy and sell directly from the stock exchange. So you can't go and just buy stocks. That's not, you're not that person. And you can't, whenever you get online, go to E-Trade or whatever, that's not you buying a stock online from the stock exchange. You need a brokerage firm. So a brokerage firm is a company, organization, a person, whatever, who is facilitating buying and selling investments on the stock exchange. So we have two different types. We have full service, and these are places that are brick and mortar businesses. You go to a person, you talk to a financial advisor. Edward Jones here in Salem. We've got a guy, can't think of his name. Joe Brand. He would be a financial advisor. He is a trained professional who's going to help you make investment decisions. They're going to walk you through everything. They're going to be a person that you can physically talk to and get kind of one-on-one advice about your situation. They're going to offer lots of different types of investments, but they're also probably going to charge some fees. A discount brokerage firm, by name, is going to charge less fees, but this is something like E-Trade. They're only there to complete the order of you wanting to buy and sell investments. And so typically you're not getting the personal attention, you're not getting the personal advice, or whatever else it is that you are hoping to get out of the scenario. There we go. Did I answer the question? What is the difference? Okay. Discount brokerage firm fees. So one thing to note is that all brokerage firms charge fees for their services. So there are lots of different ways that they can charge fees. They can have service fees, maintenance fees, inactivity fees, fees for a specific type of investment. Or if you're looking at the full service brokerage firms, they may ask for a percentage of your investment value, or a percent of the amount that you invest annually, or an hourly rate, or a flat fee, or commission. There's a lot of different ways that they might request these fees, but you have to just make sure that you know about the fees. You do what you can to avoid them, but you can't avoid all of them. Okay. I think I answered everything. Okay, so questions that you might ask when you are wanting to choose a brokerage firm, listed here on the screen. You do just want to make sure that you know that the person or their firm is a trustworthy business, that they're in good standing with like the Better Business Bureau, that they are not going to take your money and run, essentially. You're wanting to kind of screen them and make sure that this is going to work out for you. And lastly, tax-advantaged investments. So these are going to be investments that you get a benefit out of because they are going to be reducing, deferring, or adjusting how much you have to pay in taxes. That's how it benefits you. So most common types of tax-advantaged investments are retirement and education. Now, why are we bringing up taxes when we're talking about investments? Because the money that you earn in the form of interest, dividends, rent, those are a form of unearned income, and therefore they are subject to income tax. So there's two ways that you will pay for taxes. One, you will pay it when the money is invested. The money can grow untaxed with help from compounding interest, and then you withdraw the money. Or you can invest the money grows untaxed, and then when you withdraw the money, you pay taxes. So either before or after. Sometimes both. That's fun. So why should you invest in an employer-sponsored plan? So we're looking at whenever you're trying to invest for retirement, you've got to choose an investment. Usually they are mutual funds, even if you're purchasing or you're putting money into a 401k, 403b, IRA. Those are buying mutual funds. That's where they're making their money. It's just that they've collected a certain type of mutual fund that they are comfortable with or whatever. Now, the benefit is that this is tax advantaged. You're going to pay, your money is going to go to the retirement account before other taxes are taken out of your paycheck. But you will have to pay taxes later. So there's one of the two, taxes before or taxes after. But if your employer offers a plan to match funds, for example, you want to put 10% of your paycheck into your retirement account, and your employer will match that 10%. That's free money. That is why it is most beneficial for you to invest in your employer's retirement plan, especially if you plan to be there for at least a year, but a lot of times they require that you be vested in the retirement plan. For example, teachers have to work at the same in the same state, I think, for 5 years before we are vested. Otherwise, we just lose it. So that's fun. And examples of retirement accounts. So 401k, probably you've heard of, and that is very common. 403b is similar to a 401k, but it's only available if you work for certain tax-exempt organizations like the government, and teachers are included in that. You can also purchase personal retirement plans that are not through your company or your employer, and that would be like a traditional IRA or a Roth IRA. We're not going to go into that anymore. We're done.